Hello and welcome to the Australian's Money Puzzle podcast. I'm James Kirby, the wealth editor at The Australian. And welcome aboard, everybody. Now, someone I was trying to get on the show at the end of last year is Eliza Owen from the CoreLogic Research Agency, specialist property research agency, because I wanted to get a view of the year ahead from someone that's sort of very deep in the property scene. And today, thankfully, we've connected and she's on the show again. How are you, Eliza Owen?
Yeah, going really well. Thank you. Great to be here.
Nice to have you back on. It's always great to talk to you. I wanted to talk to you as soon as possible, basically about, I mean, obviously we can see the reports from the different agencies, from the economists, we can see the predictions, but I did want to talk to you about what you're seeing and your own particular view of the outlook, if you like, for residential property, for property investors in the market this year. Now, I know that you guys don't make predictions, that you don't make forecasts, that is specifically announcing forecasts for the market. But tell me if I'm wrong. It seems to me that the consensus among the economists, etc., is that we should see about 3 to 5% increase in property prices across the country in the year 2024, which would be about half what we got in house prices across the country last year. First of all, we'll say, do you think that's the consensus? And then we'll take a look at how things are changing pretty rapidly, even already in the first few weeks around that.
That does seem to be the consensus, at least across the big four banks. They use CoreLogic's home value index data to plug into their forecasts. And the median of the big four is a growth rate of 5.7% at this stage for the combined capital cities in 2024.
Okay.
To say that around half of what we would have seen in 2023, which was 9.3% for the capital cities.
Okay. So 5.7 is the median of what the big four economists say. Very interesting. Except, of course, a caveat here, and I'm sure you're very happy that you don't do forecasts, Eliza, because everybody got it wrong last year, right?
Yeah, that's right. Last year,
I mean, they really got it wrong badly.
The expectation was for a decline in 2023 amid high interest rates, high cost of living, and weakening economic conditions. And instead, home values rose 8.1% nationally, and again, even higher in the capital cities.
So, should we take them seriously in 2024?
I think there is some headwinds to the outlook in the short term, at least, and that's reinforced by the fact that Melbourne home values did actually decline at the end of last year and in the first few weeks of 2024.
Yeah.
Some of those headwinds are very clear in economic data now. So, for example, the household savings ratio has fallen from highs of around 24% during the pandemic to just 1.1%, which is the lowest household savings ratio since 2007 and implies less saved for deposits. We're also seeing weaker economic growth, which is going to flow through to a looser labour market, which again has already picked up from a low of about 3.2% in early 2003 to 3.9%, steady through January, through December, but some underlying signs that labour market conditions are loosening a little bit. So again, that will have impacts for consumer sentiment, which is also very low. Mortgage serviceability and potentially appetite for new purchases.
Yes. Gee, that's interesting about the savings rate, because what rang a bell for me there was you said it was the lowest since 2007, which was GFC times. And we know already consumer sentiment is back down at GFC readings. That is Westpac Melbourne Institute ratio is down around 81. And that's as low as it's been since the GFC. So, beautiful segue into what I was alluding to at the beginning, which was, I wonder, are those forecasts already out of date? And are they even a bit bullish on the basis that in the weeks, basically, since we all chatted at the end of last year, all this pretty poor data came out with GDP is supposed to go at 1%. The consumer data very weak. The savings ratio is so low. Now, the thing that is interesting there that you mentioned was mortgage serviceability. So the ability of people to pay their mortgages, which is the absolute sort of base, isn't it? It's the benchmark on which the entire property circle moves. Because if people don't pay their mortgages, then the whole thing starts to unravel. Tell us, just what are you saying about mortgage serviceability? What were you describing there?
So there is a risk to mortgage serviceability because interest rates have increased so rapidly, going from lows of sub 2% during the early stages of the pandemic, now on average about 6% for owner occupiers, higher for investors. And once people roll off their fixed terms, which the vast majority of outstanding mortgage debt has already been through that transition, with most people moving on to higher variable rates. They've
Yeah.
coped pretty well with that so far. But importantly, the rise in mortgage rates has surpassed the 3% serviceability buffer that APRA introduced back in late 2021. So they were stress testing households to be able to service their mortgage rates, rising at 3 percentage points. On average, those outstanding rates have gone up by around 4 percentage points, according to the latest data from the RBA. So there is some risk that people may come into more mortgage stress. But on the whole, the risk of falling behind and default does remain pretty low. That's evidenced in mortgage arrears rates, which are still sub 2% nationally. And it's due to things like high savings buffers. And even though the unemployment rate is rising, it's rising to levels that are still well below pre-pandemic averages.
Yeah. I mean, look, what I'm doing here is not so much the devil's advocate, but I'm testing. Let's look at what should we worry about, instead of being sort of mindlessly optimistic that property prices will roll up, and they may. But I'm just testing, and I'm just asking you about the issues that are emerging that would make you wonder whether those forecasts of 5% are right. Some people...
Can I say though, I think that even those forecasts acknowledge softness in the beginning of 2024, and then the idea that property prices would then rise through the calendar year are resting on the assumption that the cash rate would move lower towards the end of the year. And because your fundamental mismatch of supply and demand in the market is so extreme, I think the idea is that any reduction in interest rates or boost to the demand side would increase the number of buyers in the market, which would put upward pressure on property prices.
Yeah. One of the things in that consumer sentiment survey that popped out for me, actually, it wasn't the consumer sentiment survey, it was the Commonwealth Bank Household Insights Survey, where they asked people about their spending intentions. And of course, the spending intentions were terrible. Now, there is a pattern here where people indicate that they won't spend, but they do. So just keep that there as a caveat. But part of that is their intention to buy a house, right? So they're buying intentions, and they'd say, how are you disposed towards buying clothes or a car or whatever? And then one of the questions is buying a house. And that indicator fell 40% year on year to December. This is at Commonwealth Bank, and I think that has well, I don't know. Am I overanalyzing that? Is it important?
It is important, and I take it back to we look at the Westpac Consumer Sentiment Index as well, which tends to correlate with sales volumes over time. There's a strange departure in that at the moment, where consumer sentiment is at the lowest level since the early 90s recession. And transactions did actually recover a little bit towards the end of last year.
Yeah. So you're saying what I'm saying. They said they wouldn't spend, but they did.
Well, I suspect that there's a segment of the market that is still empowered to transact and might even be doing so opportunistically. Generally, in the high interest rate environment, we've seen indications that wealthier buyers have been active in the market, even though they're being skewed to the more affordable end of town. And it's one of the, I guess, increases in inequality that we see in market conditions in a high interest rate environment and high cost of living environment, is that it's those with the wealth and the high incomes that are still able to buy and appear to be doing so.
Yes. Yeah. Okay. All right. Actually, just one more contemporary sort of throw on this. So I had talked to some economists. Stephen Koukoulas, who's an independent economist, says he thinks property prices will fall 5%, for instance, nationwide. or maybe more sort of deep in property itself? If people say, oh, well, economists are one remove, but talking about property economists, one of your rivals who you told me the last time I wasn't supposed to mention, so I won't mention them. Fine. Well, there's only 3 or 4 of you, and one of the 3 or 4 of you, they said in their forecast for the year, they gave a range, right? But they allowed the assumption that Sydney and Melbourne prices could fall. That the other regional centres might be fine and Perth might tick away, but Sydney and Melbourne could fall. So, what do you think of that notion?
Yeah, I think that tracks, and I think that it is something we're already seeing in pockets of the market. Like I said, Melbourne is already seeing a bit of a fall in value.
Yes.
Sydney's high end. So, for example, much of the North Shore in the December quarter saw a decline Q on Q. So, I think that makes sense given how high interest rates are, that it's going to reduce demand in very expensive pockets. I guess the question is, the timing of an interest rate reduction and how that kind of works to boost demand. Given
so those are just those
and you can see it in the
anticipated
rental market, right? There fundamentally just is so much housing demand that rents have gone up an average of 9.1% a year for the past 3 years. You'd have to assume that there are prospective buyers who want to get out of that rental environment and into purchasing.
Okay. Look, it seems put all that together, it seems to me that those forecasts, and we'll call them consensus, and thank you for actually telling us about that the 4 banks have an average of estimate of 5.7, was it, for the year?
Yeah.
It seems to me then that swings heavily on anticipated rate cuts. Would seem to be the number one factor that in terms of those numbers coming through in the year ahead, and demand then obviously.
Yeah, and I think that even the monthly CPI indicator, which kind of undershot economist expectations and indicates the next quarterly CPI release might be just under the RBA forecasts. That cements the case for a hold in February. And sort of strengthens the case for a reduction in the cash rate throughout 2024. And I guess on a positive note, the pace of decline in inflation, not just in Australia, but in other parts of the world, seems to be declining at a very similar rate to which it increased. So it feels like we are really over the inflationary hump.
Yes. Yeah, right, okay. And it's coming back down to under 5, say. All right, okay. Okay, very good. Now, we'll do one last thing before we go to questions. Actually, what we'll do is take a short break and we'll come back and we'll just talk about the investors and landlords, basically, and whether they're coming back into the market or they're coming out of the market, or what's the situation for the professional or the investor rather than the home buyer. We'll be back in a moment. Hello, welcome back to the Australian's Money Puzzle podcast. I'm James Kirby, the wealth editor at The Australian, talking to Eliza Owen, researcher at the Core Logic Property Group, specialist in property analysis, particularly residential property analysis, which is what we're very interested in. So that is why you often hear her on the show. Now, we looked at, I was under the impression late last year that investors, as opposed to owner-occupiers, were starting to come back into the market, and that portion of the market was starting to return to normal proportions. Is that correct, first of all?
It is. So the volume of lending to investors bottomed out in February of 2023. The latest data to November shows that has recovered by about 27%. Okay. Which is faster than the rebound in owner-occupier activity, up about 19% in the same period.
Okay. And do they break that down regionally? Do we know where the investors are going?
So it's a pretty broad-based uplift that we're seeing across the investor segment. If we look at the portion of investment finance by state, it's sort of strongest in the traditional investment market. So Sydney's back up to 40% of new housing finance going to investors. Oh, yeah. And yeah, I think that most, in fact, all of the states have sort of come off the lows that were seen
Mm-hmm.
once we got that initial shock around rising interest rates in 2022.
Okay, so they are back, particularly in the Sydney market, at 40%. What would you expect? Excuse me. Normally, investors to be 30-something% of the market thereabouts.
Yeah, so nationally, normally, a historic decade average, they make up about 34% of new loan commitments by value, and they're trending a little bit higher than that at the moment at just over 35%.
Okay, right. Okay, that's interesting. So they are back. They are particularly back in the New South Wales market, and like many others, I imagine their projections are based on the fact that rates have peaked, and that we may get a cut this year, and that would sustain the market. Just one last thing for the investor. If that's the case on their finance, and you've given us a lie of the land in terms of property price action and what's expected through the year. So you mentioned the rents went up 9% every year for 3 years in a row. And that finally moved the actual yields, didn't it? So the yields are better than they've ever been for a long time. What could the investor expect this year then in terms of the yield? And would you think rents would do that again, 9% again?
So, funnily enough, because we've had a full value recovery as well from the downswing, yields are actually kind of settling again.
Yeah.
If we look at gross rent yields for Sydney and Melbourne, say, they're still sitting at around a bit over 3%. And I personally, I'm of the view that traditionally a lot of investors get into the market for a capital growth strategy rather than rent return. And that's just based on, tax statistics, which suggest that historically the majority of investment property owners have been negatively geared. There are still your high yield markets, which tend to be the more transitory or resource-based markets. So Darwin tends to top the list with rent yields of around 6%. But we do actually get a bit of rent yield compression in periods where values are rising. And currently values are rising fastest in markets like Brisbane, Adelaide, and Perth. So I don't think it's, the increase in rent value certainly helps, but compared to, say, a portion of the property value increase, or indeed relative to the interest payments, that it's going to be necessarily a kind of positive cash flow environment.
Yeah, okay. So you can't have, it looks like you can't have both. You can't have the rising yield and the rising prices. The rising prices will neutralize to some extent the yield, even if the rent went up. The yield is sitting there at 3% or so in the cities. Okay, very, very interesting. We've got some great questions. We're going to be back in a moment with them. Talk to you soon. Hello and welcome back to the Australians Money Puzzle podcast. James Kirby with Eliza Owen. Okay, now, Eliza, you've seen these questions. Sometimes people will I have no problem. My problem invariably is with the 1,000-word question. But I don't have a problem with the 1,000-word. If there's 5 questions in the 1,000 words, then that's probably all right. So Bruce here sent a substantial email, but I think he had about 4 questions in it, in which I have extracted 2. So here's the first one from Bruce. I do wonder if this talk of landlord exodus or investor exodus is actually making the situation worse, because presumably each property sold to an owner-occupier means one less renter. But you've said the overall result is a tightening of the property market. I don't quite understand. Are people buying houses and leaving them vacant? It's a great question. It comes up regularly. Is it the case could you explain what does happen when if the investors aren't in the market? Wouldn't that necessarily imply that it's only buyers, it's only owner occupiers, and then that's better in some ways for everybody?
Yeah, so I think we need to clarify what is meant by a landlord exodus, because there's a couple of instances over the past few years of investors leaving the market. One was in 2021 where investors were selling off
Yeah.
I agree with Bruce to an extent that if investors are selling off at an unusually high proportion and assuming those are being purchased by owner occupiers, that yes, that would take a unit of demand out of the rental market. Unfortunately, I don't think it's quite as smooth or simple as net bedrooms, say, being completely flat as a result.
Yeah.
So owner occupiers tend to have larger households. If you think of one person moving out of a 5-bedroom share house and buying a 2-bedroom apartment, then you've got a net loss of 1 bedroom in that scenario, right? So I think the transition from renting to owner occupation can reduce household size. This is just theoretically, by the way. I'm just thinking
Yeah.
about where it might tighten the rental market. I think broadly I do agree with Bruce in that scenario, though. But then there's this other form of exodus, right, which was the rising interest rate environment and investors just not buying. So that suggests that the rate of rental properties being added to the market is slowing down at a time, say in 2022, when interest rates started to rise, investor activity went down. So did owner occupier activity, by the way. So there were just fewer people buying. But at the same time, we had a massive increase in prospective renters because of the return of overseas migration.
Mhm.
That investment activity, as we've just discussed, has now recovered. But you've still got that time period where new rentals added to the market were going down. And I think we're still kind of playing catch up on that. And that
Okay.
helps to
Yes.
explain the tightness in
Yeah.
rental markets.
Yeah. And I suppose that the essence of what you're saying too is also it's not simple math. It's not like one out, one in, as you might expect it to be. So the investor sold the house around the corner. Does that mean the house around the corner is suddenly in the owner occupier bucket, as opposed to the investment bucket? It's not quite so simple as household formation can change so much. Okay, second
Yeah,
question from
yeah.
Bruce. You mentioned the Canberra ACT has a type of rent freeze, excuse me, for some years, but the Canberra rental market appears to be booming. Is this because of the rapidly growing Canberra population, or are landlords basically interested in capital gains? So rental income becomes a minor issue. Very interesting. Everyone says, oh, a rent freeze, or you couldn't have a rent freeze. That would drive the market through the floor. And economic textbooks would suggest that's true. But it turns out inside the curious world of the ACT, they have one and always had one. And Bruce says they're going fine.
Yeah, again, I would sort of challenge some of the assumptions in this question. So the Canberra rent market is one of the only markets where rents are actually falling right now. They were down 2% year on year. But in a way, that's an argument in favor of advocates for the rental freeze.
Is the drop in the rent linked to the rent freeze in Canberra?
Well, you know, because the argument, first of all, when we say rent freeze, it's that you can't increase rents by more than 10% of the increase in rent CPI.
Yeah, there's a cap. Yeah.
So it's not as if rents are frozen, but the idea is that you can only increase them by so much. Now, initially, the backlash from the real estate industry was, well, if you implement any kind of cap on rent growth or regulations for landlords, they will leave the market and that will drive rents higher.
Yeah.
That didn't happen. Rents in Canberra are actually falling. I wouldn't say it's tied to the rent freeze. I'd say it's tied to the number of unit completions in particular that this market has seen in recent years. There's been a big unit construction boom there in the late 2010s, which has helped to keep rents lower, paired with some unfavorable migration trends there for a bit, people leaving Canberra for other states and territories. So I think what the Canberra rental market has shown me over the past few years is that if you do implement a cap on rent increases, it doesn't necessarily lead to a massive loss in supply and spike in rents.
Right.
We might start to see more investors dissuaded from the market long term. I don't know, but at the moment, it hasn't had much of an impact.
Okay, but it is just one city. And a curious city at that. Yeah, as opposed to, conventional, as opposed to a conventional city. I just mean that, as everyone knows what I mean. It's the nation's capital, and it is not a typical city in its construction or indeed in its demographics. Okay, now final, but very interesting. So I think what we can take away from that, Bruce, is that the rental, and it's not a freeze, right? It's the rental limitations imposed in Canberra. There's no evidence in Canberra that they actually brought about rent spikes, which is an argument against them in other states, or in other cities. Tom says, is there any data, this is really interesting, on the net wealth of immigrants, particularly to Melbourne and Sydney? My sense is that the wealthier immigrants make a beeline for Sydney, with less cashed up entrants settling elsewhere. Is that true? Have we any data on that one?
So, yeah, great question. To be honest, I don't have data. I'm sure it's somewhere across DFAT data or ABS data. What I do know about migrant patterns from overseas is that around 30% of them historically, Melbourne accounts for around 30% of Australia's net overseas migration as a whole, followed very closely by Sydney. You'd have to think these cities are a little bit self-selecting when it comes to the income of people going there, just because median rents across Sydney are so high, $745 a week at the moment at the median level. Melbourne is actually one of the cheapest rental markets from that weekly rent perspective at $535 per week. I don't know the wealth again, but we know, for example, from DFAT data that skilled permanent migrants are in highest proportions across New South Wales and Victoria. So it suggests people specifically go there, maybe because they have a higher income, but also just because that's where most of the jobs are in some of our professional services industries. So, yeah, I think that's sort of what I know of the demographics that are going there. And we've also heard from some academics evidence of people starting in Sydney but then moving to Melbourne because it is more affordable.
Or they find out it's more affordable, maybe. Yeah,
but I think Sydney unfortunately does become just more and more for the wealthy over time because the rent values are so high.
Yeah. And of course, if the person is offered the same salary and can choose cities, which I'm sure regularly happens these days, especially since location is less important than it used to be, then why wouldn't you, especially if you didn't know anything about the two cities and you had just arrived, they looked more or less the same to you when you arrived. They did to me, at least, once upon a time. They now look very, very different. But at the time you say, oh, well, what's the difference? They're more or less the same population, the same salary, except, whoa, the rent is so much cheaper than in that one called Melbourne. Why wouldn't you go there? So, I mean, maybe substantially a part of the explanation is that people either know that in advance or they discover that after a period. So 1 in 3 come into Melbourne then. And if 500,000 plus came in last year, then we had like nearly 200,000 come into the city in 1 year.
Presumably, that's based on the historic trend and extrapolating it to current migration figures. But we'll get an update from the ABS, I think sometime this year, about what that more specific regional migration looks like.
Yes, yeah. Well, it certainly feels like that on the streets. For the city's marvelous to see the heaving again. Really, in the last few months, finally shrugging off the last of the COVID sort of hangover. It seems like that, certainly in the tempo of the city of Melbourne. Okay, terrific. Hey, thank you very much for coming on the show today. Lovely to have you on. Really interesting observations. I know you didn't make those forecasts about the property market, and I kind of challenged you as if you had. But it was good. It was good to, I think, stress test them for our listeners who take those forecasts very seriously as you have to hang on to something if you're making long-term plans in the market. Okay, thank you, everybody. You know the email, themoneypuzzle@theaustralian.com.au. Eliza Owen, talk to you again soon.
Great, thank you.
Okay, talk to you soon. Bye.